For the last 2 years, the US government and Federal Reserve have told us that this high inflation that we're seeing is transitory, meaning that it was spurred on by the economic issues from COVID and it should be short-lived. It should be settling down. And yet here we sit in June of 2022, and if anything, inflation is ramping up. Now, for obvious reasons, higher inflation can be quite alarming to retirees. In this video today, I'm going to talk about 4 ways that you can combat inflation within your retirement plan. High inflation is generally bad for fixed income and guaranteed income streams. If you have a monthly pension of $2,000 per month and inflation is 10% over a given year, well, you still are earning that $2,000 paycheck each and every month, but now it's worth significantly less because it purchases significantly less out in the marketplace. Well, there is one guaranteed income stream that actually defends against inflation, and that's Social Security. So Social Security has a cost of living adjustment built into the system. For instance, going into 2022, we saw a 5.9% increase in Social Security benefits across the board. Now, going into 2023, we expect this number to be even higher based on the higher inflation we've been seeing. And if we look historically, these cost of living adjustments have done a pretty adequate job at keeping up with inflation for retirees. If we go back into the late 70s and early 80s, it was not uncommon to see these cost of living adjustments above 5% and even jumping into the double digits for a few years. As you're delaying your benefit, you're earning a larger benefit, and therefore those inflation adjustments will be larger on an ongoing basis in dollarized terms. And no, because of these COLA adjustments, depending on where we see inflation rates, it will move your break-even analysis for Social Security. For instance, if we look at normal inflationary times with inflation running at 2.5%, and we look at the difference between filing at 62 versus delaying to 70, we would expect that break-even of delaying until 70 to fall right around age 83. But if we assume inflation at double this given rate, inflation at 5%, we find that it moves that break even 3 years earlier to age 80. And so understand, when we see higher inflation, it will move that break even forward, thus making delaying Social Security that much more valuable. The second way to protect against inflation is hold assets that have a consistent history of growing your wealth through inflationary environments. Now, there is no better growth vehicle that meets this definition than stocks. When you own a share of a stock, you own a share of a business. And when we look at the history of stock performance, we can see centuries worth of data that stocks have historically outperformed inflation, and we can see this across different markets globally. For instance, on the screen, you will see inflation-adjusted returns of a couple different asset classes. Now, we can see that stocks, going back to the 1800s, if you would have invested $1 in stocks, it would have turned to $705,000 in inflation-adjusted terms by 2012. Compared to a few different asset classes, there really is no comparison. Now, things like real estate are often thought of as a better inflation-adjusted asset. But on the right-hand side of the screen, we can see inflation-adjusted real estate prices going back to the 1900s. And as we can see, a lot of the growth in real estate in inflation-adjusted terms has really happened over the last 2 or 3 decades. Now, we can see stocks outpacing inflation even when we break out performance on a more granular level and look at given decades. And what we'll see during the 3 highest inflationary periods going back over the last 90 years, we saw stocks provided a positive return. The only decade where we saw stocks have a negative inflation-adjusted performance was 2000 to 2009. And that was more so because of 2 bear markets during that given decade than inflation running out of control and hampering stock returns. Now, that being said, stocks typically do better during lower inflationary environments, but nonetheless, over the long term, we see that stocks adjust quite well to inflation. Now, understand that stocks outperforming inflation is not just some American phenomenon. We've seen stock outperformance across markets globally. And in some of these given markets, they've seen higher inflation over that last century as well. And on the screen, you can see that equities have consistently outperformed on an inflation-adjusted basis relative to numerous other assets. Now, understand that this doesn't mean that if inflation rises 2%, that stocks will immediately rise 2% as well. There are a few assets that perfectly adjust to inflation. But understand that over the long term, there is no better asset class to outperform inflation than owning businesses. Now, outside of stocks, what other assets can we add to our portfolio to have some built-in inflation protections? There are a lot of ideas being thrown around right now with inflation-protected bonds, using real estate or real assets like commodities, or even using gold as an inflation hedge. Now, when we look at developing a portfolio, it's very important that we don't just look at single assets. We have to be looking at the whole picture and how each of these assets works together. To give you an example of what I mean, I have 3 hypothetical assets on the screen here. Now, a mistake that I see a lot of investors make is they simply look at the 2 best individually performing assets, combine those together, and think it will deliver the best portfolio. And this isn't the case at all, because we're leaving behind an important principle of diversification called correlation. Correlation essentially describes the movement of 2 assets together. And with diversification, we know that we need non-correlated or even inversely correlated assets. So for instance, asset C on the screen looks like a little bit of a dog. It really doesn't go anywhere. But when we combine it together with asset A, it will build a better portfolio because it is non or even inversely correlated. And so we need to take this idea and apply it when we're building our optimal portfolio for retirement. And when you take this idea and apply it to your portfolio, it's interesting to see that gold as an inflation hedge can actually be an additive to a portfolio, or at least historically it has been. Now, there are a wide variety of opinions when it comes to gold. On one extreme, you have gold bugs that really only want to hold gold, see that the government is printing money, and think that gold is the safest storage of wealth. On the other hand, you have advisors and investors that absolutely hate gold. You can't really value gold from a pure valuation standpoint. Gold doesn't deliver any income, and so what we can expect from gold moving into the future is kind of a question mark. But historically, we've seen that gold has actually been quite an interesting portfolio additive as well as inflation hedge. For instance, the last time within the United States that we saw high inflation through the 70s and early 80s, we saw that gold returns were quite significant. But a point that I think is very important to note is any inflation hedge or really any part of our portfolio that we're adding in right now, we need to be comfortable holding over the long term. For instance, right now commodities are doing quite well. But if we're planning on jumping into commodities as we see higher inflation and jumping out of commodities as inflation calms down, we're likely going to be whipsawed in a way that hurts our overall returns. And so we need to hold given assets that can be a long-term inflation hedge, but we are also comfortable holding when inflation drops back down to normal levels. And out of all of the inflation hedge options available, I think gold is one of the most interesting because it's historically been a non-correlated asset. For instance, on the screen, you'll see drawdowns in a classic 60-40 portfolio, and you'll also see gold returns relative to those given drawdowns. And what you'll see during times of significant drawdowns within a 60-40 portfolio, we see that gold returns are quite positive. Thus, we see diversification benefits from adding this to a portfolio, at least historically. So we're going to be comparing an all-stock portfolio to a stock portfolio of 90% with 10% gold added in. And we'll go all the way back to the 70s. And what you'll see here, by having a non-correlated asset like gold, we'll see there's these diversification benefits. We see going back into history, there's a slight improvement in the compounded annual growth rate. We'll see that there's a slight decrease in standard deviation, so the volatility of the portfolio. And we'll also see a decrease in max drawdown. So this is exactly what we want from diversification. We want an asymmetric risk-return trade-off. Higher returns optimally with lower risk. I should also note that this is historical performance and there are no guarantees of future performance. Again, I think there is some validity to the idea that there is no guarantee for what gold will do in the future. It is not an asset that can be adequately valued. Historically, however, it's been a good hedge and has some diversification benefits. Now, relative to some other inflation hedge options like commodities, we see that commodities no longer add those diversification benefits. In fact, they tend to drag down performance in non-inflationary environments. Now we're looking at data from 2007 until now because of the availability of data with commodities. And we see during this shorter time period that once again, gold has those diversification benefits. Commodities, however, end up dragging down performance during years where we've seen low inflation. We'll see a very similar picture play out when we look at adding real estate instead of commodities or gold as an inflation hedge. We'll see that real estate has too high of a correlation to stocks, thus we don't see those same diversification benefits. In fact, when we add this as a 10% allocation to a stock portfolio, we actually see a reduction in compounded annual growth rate with increased volatility as well as increased max drawdown. Thus, we don't get those same diversification benefits. The final way to protect your retirement from inflation is a little bit more of a counterintuitive one. As an exercise when I was developing this slide deck, I looked at what others were recommending for protecting your retirement from inflation. I found a consistent idea was to save more and spend less. And on the surface, this makes sense. If we have to keep up with inflation, we should be spending less so that we have more available moving forward into the future. But if we're in retirement and we're constantly saving more or putting off that spending date may never come. And then what was the point of saving all of those assets? When we look at $75,000 inflation adjusted through time, and we look at varying inflation rates, we'll see that the majority of the gap between inflation adjusted spending comes when we're looking down the road, not right away. Many retirement planning approaches assume that spending needs to be static through time. If we have a $75,000 income need, we need to make sure we maintain that income through time and adjust for inflation. But in reality, we see that retirement spending follows a little bit more of a smile, where we see higher spending at the beginning of retirement when we're the youngest, and then it fades as we grow older, only to see a ramp up once again towards the end of our life due to healthcare costs. And so it's really that discretionary budget that we use to travel, we use for hobbies, we use for more of an active lifestyle that ends up fading. And so on the screen, you can see a couple different examples of this retirement smile. And so someone that is currently retired, understand that you already have an inflation protection built into your retirement plan. Studies show that you will decrease spending as you age. And so despite there being higher inflation, understand that your decrease in spending will likely offset a good part of that inflation. And before you go ahead and make any adjustments because of some of the fear around inflation and decreased spending, you should rerun your plan or have your advisor rerun your plan under more accurate estimates. For instance, if we look at normal inflation at being at 2.5%, and we look at the base case of this hypothetical person's plan, we see they're at a 95% probability of success. Now, what happens if we see inflation significantly higher over the entirety of their retirement, and we see 4% inflation rather than 2.5% inflation? Well, under the brute force spending method of needing to keep their income static through time, we see that they see a pretty big adjustment to inflation. This might lead somebody to spend less or maybe delay retirements altogether. But if we plan to more realistic spending assumptions and we use that retirement spending smile, now we see that inflation doesn't really have that big of an adjustment at all. 95% probability of success drops down to a 91% probability of success under 4% inflation. And now this person should still have the confidence to retire on the timeline that they ultimately want and still spend in those early years according to what they were planning on before. Now, as we went over these 4 inflation protections for your retirement, some of you may be screaming at the video. I left out a major inflation hedge that is quite attractive right now. There is a government guaranteed bond paying an annualized rate of 9.62% and is designed to continue to keep up with inflation moving through time. Now, the reason I left this off is because there are certain constraints that you can learn about with this bond by clicking on this video right here. Always remember, you don't need more money, you need a better plan. Thanks for watching.